Joining me now for a closer look at what's playing itself out in that market scene is Cobus Potgieter from Southern Cross Capital. Cobus, always a pleasure. Hello.
Good afternoon, Alatanda. Thanks for having me.
Thank you so much for chatting to us, Cobus. Lots happening today here at home and I think around the globe always. Maybe keen to get your thoughts on what's driving today's performance. We are seeing more hammering for resources. Capitec doing super well. Maybe we can touch on that as well.
Yes, divergent is what we would call it, but to some extent, it's just a reversion of the trend we've seen earlier in the month. Precious metals have been on an absolute tear, and industrialized metals, base metals as well. And those are selling off quite aggressively today, also off the back of some of the numbers you mentioned from the likes of Kumba and the whole Anglo group. On the flip side, we've seen some boisterous support coming through from the Chinese market, and that's really driving the industrials, as well as a bit of optimism in the financials as well, which have taken a beating month to date. So that's all sort of netting to zero, isn't it, from a South African perspective? But then the more developed markets, we're firmly in the black today.
Let's talk about those developed markets, because a big conversation we're having globally here, Cobus, is the correction in the United States after certain stocks ran really hard. I'm just keen to get your thoughts on which stocks we are seeing most correction around, and this narrative of real fair values being seen on the bourse right now.
Yes, it's tricky. As we've seen, it's difficult to call the top, of course, but even the substantial sell-off we saw now in the last week or so, people took that as an opportunity to buy, and now we're shifting from this focusing on the Fed's monetary outlook to focusing on earnings instead. And perhaps that's a bit of realism getting baked in. And somebody mentioned that only 3 of the Magnificent 7 are still magnificent, which, to some extent, that's a little bit of rationalization. Those 3, of course, being Nvidia, Amazon, and Meta. So the other 4 have been laggards, and Tesla in particular, decreasing earnings. Apple has got the issues in China, falling to 3rd position there from 1st overall. At this stage, I still think the overall outlook for these stocks is reasonably positive, given that we are likely to see more robust earnings coming through. The GDP numbers have been good. Employment's good. The American economy is certainly quite defensive. And we probably do another decent results season. And as that remains in focus, I think those stocks will remain supported.
Yeah, well, we like earnings season. It's a little bit more predictable than watching monetary policy and all that data, Cobus. Let's look at some company news coming out here at home today. Capitec really knocking out the park, all the key metrics, double-digit growth. I thought what stood out for me there is that they say that 72% of their income is non-interest income, and that's an interesting dynamic.
Yes, absolutely. Look, the drive towards more transactional income versus net interest income has been that's been the thesis around that stock since the African Bank collapse 12 years ago now. So that's been executed incredibly well. The crediting payments, as anticipated, did increase significantly. I think it increased to over 8%, but this is still within the 12%, 8 to 12% range that they try to manage it. This is still a credit lender after all, but the top line growth was phenomenal, up at 21%, despite personal loans only growing at a sort of benign 2%. We saw the business side grow significantly, very aggressively, even though the impairments there have also picked up significantly. And then the cost control has been decent. When you're increasing revenue by 21% and costs only by 17%, you get really nice margin expansion. Well, the market seemed to flag the beat on the dividend, but a dividend on Capitec is so meaningless. It's a record 35 Rand dividend, but the rally today alone is in excess of 160 Rand. So, decent set of results, and hopefully, the credit environment not being as terrible as was thought reads through to the other banks as well in time.
Very, very interesting indeed. I'm keen to get your thoughts also on some of the numbers coming out of the Anglo stable there. Quite a lot coming out. I think the overall theme here, though, is that Anglo-American seems to be battling. When we look at De Beers and the diamond mining, or we look at Kumba, even Amplats, all of it speaking to a decreased production and just strain overall.
Yes. Look, I'm hearing a lot of Transnet. It seems to be the theme. I think that there's hope that this has bottomed out, and ultimately we'll see these poor operational performances into a market that's become a little bit more supportive for most of these commodities improving. I'm sort of developing the thesis. If there's sanctions in Russia, if that supply constraint can manipulate or push these prices up. Surely the mafias that are making it difficult for Transnet to function are doing the same thing. You're creating artificial scarcity, but there's no difference between artificial and real scarcity from the market's perspective. So we need to address this and to try and test this market and participate in the upward swing in the commodity cycle. We're seeing the outlook's improving for all of these commodities, and we're having difficulty performing. The one major upgrade we saw within Anglo's, of course, is in the copper production, and I think that's giving at the holding company level, giving it a lot of support relative to the Kumbas and the Amplats.
I must also ask you, touching on Sasol here, just your thoughts there. We are seeing those chemicals, prices really benefiting the United States, not here at home. But Sasol as a whole, as a business, Cobus, any green shoots, and maybe even what Sasol could look like in the future?
I think that part of the problem is that management don't have a clear picture for precisely that. So I don't want to be one of those portfolio managers that comes on here and bottom fishes Sasol. I acknowledge it's cheap, but forgetting for a moment the chemicals business performance, which is frankly turned out to be not that attractive a business given the oversupply in production that sort of went up simultaneously with Sasol's own project. Locally, the core business, the Syntheos business, is underperforming. And the outlook on that is still very negative. Ultimately, if they had to adhere to the emissions regulations, which our own government is propagating, that business simply loses all sustainability, and there's no real exit path for that. So for me personally, it's sunset, and even if there is value in the short term, extracting value from those assets is very difficult. It looks like a value trap to me.
Absolutely hear that, Cobus. Keen to get your stock pick now, but before then, let's reflect on counters that have found favor with your industry peers.
So COPEX, it's an ETF that trades in NYSE. So rather than copper is sort of kind of the flavor of the month at the moment, rather than try and figure out like which mining company has the best copper exposure, the easy way out of this is just to do a COPEX. It's a basket of the largest copper miners, trading around about $45. There is $44.82. The more I'm hearing about copper, the more we're understanding that there's a shortage going in, and it's the one sort of commodity that's holding up quite nice.
I'm going to go with Exxaro. So there are two commodities that you're getting exposure to. That's coal and iron ore. Both have come off their highs, but they're looking much more solid here. Coal demand remains good. I think what's weighing on the rating, it's come a large dividend. It's still got a massive dividend yield around 19%. They look like they're returning capital to investors, their large cash pile. And I think Transnet freight rail, their performance has been poor, but can improve from here. So I think once that improves, we can see the share re-rate, but you're getting a healthy dividend. It's cum dividend, a lot of downside protection at these levels.
We saw that huge big rout in the semiconductor sector last year. So, and I've called this company before, and it's ASML. It is a Dutch company. It is the company that makes the machines that make semiconductors. Now, it's expensive. It's been difficult to buy into, but this company's a monopoly. It's got about a 50% margin. And semiconductors, despite the fact that that sector is extremely cyclical, it is the way of the future. So people who have missed picking this monolith up and putting it into their overseas portfolios, you're possibly going to get the opportunity to do it now. I don't think it's ever going to be cheap, but this is one monopoly that I really do think everybody should have in their portfolio.
All right, Cobus, keen to get your thoughts on some of those, Copix, Exaro, as well as ASML.
Okay, Rowan is my old boss. I worked for him for 8 years, and never before have I seen him pick a resources stock.
Interesting.
But I would agree with him this morning even more. Off the back of I think what we heard from Kumba, Exaro has fallen even further, and perhaps we are looking for the bottoming out. They seem to be taking some corrective steps around cleaning out those bottlenecks within the rail lines, and hopefully, given the sort of green shoots we are seeing for coal and iron ore, the stock is cheap as chips at the moment. It's around a 4 PE, yielding incredibly nicely. So it's very hard not to like at these kind of levels. Copix is an interesting one. It's the second time I've heard that name in the last week. And though I do like it, my favorite play in that space is actually Anglo's. If you strip out the underlying Kumba iron ore and Amplat's exposure, Anglo is the holding company, which should essentially give you exposure mostly to copper and De Beers, is up around 50% since bottoming out a few months ago. That's gone from around 200 Rand a share to 300 Rand a share. Again, I guess you should have a hedge fund if you want to exploit this view very specifically, or just be underweight iron ore and Amplats across the rest of your portfolio. But ultimately, on a relative basis, that has been a very nice geared exposure towards copper. If that's a play you want to make in the local market, that's a really nice one. ASML, very esoteric, incredibly high quality monopoly. It's dipped recently, so probably this is in all likelihood a nice entry point. It hasn't rallied with the other tech stocks as of yet, post the sell-off, but at a forward PE of 41, it is looking a lot like those Magnificent Seven stocks. But high quality, well positioned, and given the investment we're seeing into semiconductor manufacturing globally, because of the so-called risks, geographical risks around Taiwan in particular, and the political issues around political tensions between China and the US, and expansion of foundries on the US mainland, that should continue to support that business a lot going forward.
And with that said, Cobus, which counter do you love this afternoon?
I'm going to go boring. I also always go esoteric, but buying into the momentum now. Naspers or Prosus, depending on which one you already have in your portfolio, they are looking cheap relative to Tencent. Tencent finally seems to be getting some momentum back, and I'm still bullish the Chinese economy. I called that Chinese ETF, STX China, Satrix China, a couple of weeks ago. And we're seeing the Chinese tech stocks pick up significantly now. I think the outlook is turning. I think that market is getting a lot more support, and you want that Tencent exposure, given it is so cheap and given there is substantial upside there. And you can get it through a local stock in the form of either Naspers or Prosus, which are reasonably well priced.
Brilliant, Cobus. An absolute pleasure having you with us, and thank you so much for your time this afternoon. That was your Midday Markets Update with Cobus Potgieter from Southern Cross Capital.